Stock market comeback. Check out these numbers. The Dow, the S&P 500, and the Nasdaq surged yesterday after Federal Reserve Chairman Jay Powell's comments on interest rates.
Interest rates are still low by historical standards, and they remain just below the range of estimates of that level that would be neutral for the economy, that is, neither speeding up nor slowing down growth. My FOMC colleagues and I, as well as many private sector economists, are forecasting continued solid growth, low unemployment, and inflation remaining near 2%.
Joining us right now is Tiger 21 Chairman Michael Sonnenfeldt. Michael, it is good to see you. Thanks so much for joining us. How's the sentiment in terms of your members?
Our members are trying to have the discipline that when the market went down 600, they didn't overreact, and when it goes up 600. But clearly, interest rates and tariffs are the story of the day. Are the tariffs really hurting the economy? And what's going to happen with the exploding deficit? And will we get some infrastructure? These are the bigger stories they're dealing with across the country.
Are they impacting things, the tariffs, right now? I mean, look, we've got news this morning in terms of companies making moves in the auto sector as a result of these tariffs.
Yeah, there's no question that auto, for sure, particularly with the news around GM and what's going on, tariffs are having a huge impact on the auto industry. We have members in our Detroit group who are clearly worried because with the closings of GM, that has an impact. Real estate prices are probably still too high. That group is waiting for prices to come down, and they've taken some real estate off the table in the last quarter.
Trying to get a sense of how you think your members, investors generally, might react to any news we get out of this weekend's G20 meeting. Obviously, both the U.S. and the Chinese side have kind of downplayed hopes for a solution to the trade dispute. But what if, at the dinner, Xi Jinping and Donald Trump solve it? What if we have an agreement or maybe a framework to get to an agreement?
Sure. So I would say that that would be very important news. But when our members meet in groups every month, they're sort of struggling, like, what's the really important news and what's going to happen? And they try to have an all-weather portfolio. So when I was talking to a member recently, he was saying it was an interesting thing. He's shorting 100-year bonds. Why? Because if interest rates come up a little, those bonds are going to be a great stabilizer as they fall. The Australian market's way overheated. American real estate, somewhat overheated, sector by sector. So our members in the last two quarters have taken about 10% of their holdings off the table.
So when you talk to your members, I'm kind of talking my own book here because we invest venture capital, private equity. So much focus on unicorns right now in the market. How do your members see that, and do they want to be involved in the private space?
Totally. The largest shift over the last decade in our membership is private equity, grown from 10% to 24%, all-time high. So as real estate is coming down, all-time high to private equity, now exceeding even public equity, 23%, private equity, 24%. Why? Because in venture and in private, you have these scalable businesses, given our technology. That's where the action is, not as passive investors. Our members were the great entrepreneurs who built businesses, so when they sell their business, what they can do is invest in another business where they can be on the board or they can actually kick the tires and understand really what's going on.
Does that tell you anything about where we are in terms of growth, this optimism about the unicorns?
So what it tells you is when you see real estate coming down so quickly, that's the biggest sign that those markets are frothy. But in total, our members are allocated over 73% to public equity, private equity, and real estate. That's a pretty long-term bullish referendum on the U.S. economy. So I would say long-term, optimism about the U.S. Short-term, we're in choppy waters, but still sailing fine.
And I would assume that they're the type A personalities that, like you said, have built things, so they want more control. So being able to invest private and have a little control from a board level or whatever it may be.
Absolutely. And if you compare it to, say, the public equities today, take Apple or GM or Facebook, these are big stories. But our members have learned that they can't time the market. So if they overreact to any one of those stocks one way or another, history is very clear. They can't time the market. They're better off with an index fund or a long-term holding. Even take an Apple, which is in bear market territory today, still up for the year. So if you're a long-term holder, if you're a 10-year holder, you're still in a holding position.
Wanted to ask you, you mentioned Australia being overheated. Fed Chairman Jay Powell yesterday said they've had 27 straight years of growth. if you get 27 straight years of growth, you probably ought to have a sky-high valuation, right?
It's a little geriatric in the cycle right now.
That was a funny comment about Australia.